All right, so we are recording. Good morning, everyone. My name is Diana Schulak. I'm the program manager at Family Focus Resource Center. I work out of our office in CSUN at Cal State University, Northridge. We have 3 other offices located in the lobbies of the North LA County Regional Center. So that's Chatsworth, Antelope Valley, and Santa Clarita. We are available. This workshop today is going to be recorded. We will be putting this on our YouTube channel. And Eduardo Iniguez, who is our Latino task coach, who's now done this workshop for us for the past, I think, 4 years, Eduardo, or 5.
Just about.
He is going to do this wonderful presentation that I was letting him know that is always one of our most watched on YouTube because it's so helpful and the information is so imperative, especially at this time of year before tax season starts. So it's a good thing that we record this so you can go back and watch anything that you missed. He will be providing his slides, so I will be sending those out to everybody who's registered and attending today. So now that we have started recording, I'm going to pass it over to Eduardo. Eduardo, thank you so much for being here.
Thank you very much, Diana. And once again, thank you for the invitation. Like you say, this is probably like the 4th or 5th year that we've been collaborating and bringing you this type of presentation for all our living IHSS providers. So let me go ahead and get started here. Let me share the screen. Just let me know, Diana, when you can see the presentation on the screen.
Yes, we do see
You can
this.
see right there.
Yeah, we see the presentation, and I forgot to mention if we could withhold your questions until the end, so that way we don't interrupt the flow of the presentation. If you do want to, if you feel like you're going to forget your question, you can place it in the chat, and we will go through the chat questions at the end. But please withhold your questions, and then we will go through them.
Perfect. All right, so good morning, everyone. Thank you for joining me today. My name is Eduardo Iniguez. I'm the owner of Latino Tax Coach LLC, a tax preparation office located here in the city of Commerce, near here, LA. Over the years, I work closely with families to help them navigate the tax law, financial planning strategies, and today's workshop is focused on a topic that is especially important for many live-in providers. So, because you will be understanding the basic tax law. Regarding IHSS income and exploring the best investment options for your financial goals. So whether you're new to IHSS or have been a provider for years, this presentation is designed to give you a clear, practical insights to help you make the most of your income and secure your financial goals. So as you can see on the screen right there, a little bit about myself. I have over a decade of experience. I am a certified tax preparer with the state of California, but my specialty is actually the IHSS income. I'm a father of 2 children with disabilities. They are both autistic, and I reside here in the city of Los Angeles. So enough about me. So let's focus now about the actual topics of this presentation. We're going to be covering 5 major topics. The first one is going to be the IHSS tax regulations. So we need to start with the basics. We need to see who qualifies for the tax exemption. We often hear that IHSS for living providers, this type of income is tax exempt. It's not automatically exempt. You need to meet certain requirements that are established by the IRS in order to qualify for the exemptions. On top of that, when you hear the word taxes, taxes is not, there's basically various types of taxes. There's not only one type, there's multiple types, and each one of them has its own set of rules. So the rule for IHSS for tax exemption only applies to certain types of taxes, not all of them. So we're going to go over those basics. Number 2, the updates. Many of you may have received an email about a week or so ago from the IHSS agency stating that beginning with this, with calendar year 2024, this year's taxes, you're going to be receiving a W-2 form. That came as a surprise for many of you, especially those who have not received a W-2 for many, many years. So this is a huge change that has, in my opinion, more benefits So we're going to be going over those updates and details, and I'm going to be also showing you on the screen how the actual W-2 should be looking, how it should look for this upcoming tax season. Number three, we're gonna briefly be going over life insurance. This is an area of the financial planning that had been requested by a lot of you to go over and talk about the basics of life insurance, and especially what really motivated me to talk about life insurance is because unfortunately last year I got to experience a lot of uh, passings, unfortunately, from people that I knew very closely, who were IHSS providers, and not only them as the parents, but also I saw cases where unfortunately children also passed away. So we're gonna talk about how life insurance could benefit you and your family in case you happen to have this unfortunate tragedy in your family. Number four, we're going to be talking about credits. What are the credits that are available for your dependents? We're going to be talking about the main two tax credits, which are the child tax credit and the earned income credit. What are the requirements and how much that you in credit that you can actually get? And within that section as well, we're going to be describing the special rules for children or dependents with disability. Once those children become adults, that's where a special rule applies when they have a disability. So we're going to be going over that special rule. And lastly, we're going to be talking about retirement. The tax exemption for IHS regulation has its benefits and also some not so good benefits. And that again, that tax exemption has a direct impact on your retirement benefits. So that's where we're going to be also um, covering this area in great detail so you can understand what will happen or what you expect when you reach retirement age. So let's start here with the basics. Taxes. Any employee, if you're an employee here in the state of California, you're basically required to pay five type of taxes. I'm going to group those type of taxes into three different categories. The first category is the federal and state taxes. Thus, the purpose of having these taxes is just the way the government generates funding for their projects. You know, if the government was to set up schools, police stations, firefighters, etc., that's why they charge this type of tax. That's the way they raise revenue. The other group of taxes is the FICA and Medicare taxes. FICA is basically your Social Security tax. Is the way that you fund your own benefits once you reach retirement age. Medicare itself is a special type of health insurance once you reach the age of 65. So that's the purpose of you paying these two type of taxes is mainly for retirement age. And the third type or the last type of tax is called the California SDI. SDI stands for State Disability Insurance. It's a disability insurance in case you get involved in a type of accident outside of your job, and that accident prevents you from actually going back to work. So it's a special type of insurance that applies mainly to California. So these are the various types of taxes that are available. Now let's talk about the tax rules govern about the special tax rules for live-in providers. So in order to qualify to be exempt from any of these three types of taxes, or three groups, I should say, the first one, the federal and state taxes, you are exempt from paying this tax if you, as the provider, reside in the same household as the care recipient. That's actually the majority of the cases for IHSS providers. The great majority of you are live-in providers, and usually you provide your services to your own children. So that's the vast majority of you. So that makes you automatically exempt from federal state taxes. The other two groups, FICA and Medicare, and the California SDI. So if you happen to be the care provider for your own children or your spouse, that will also make you exempt for the remainder of the taxes. So the vast majority of you, when you see your paycheck, basically you have zero deductions because again, the majority of IHSS provider happen to be parents providing their services to their own children. So let's look at this in another way right here. If you're the provider, as a provider and the participant reside in the same household, the provider is neither the parent nor the spouse. That applies to you. You will not be paying the federal and state taxes, but you will pay the FICA and Medicare taxes and the California SDI. An example would be if you're the care provider for your own parents. Under that scenario, you will only pay 3 out of the 5 taxes that are available. If you are a provider for one of your siblings, then the same under this scenario, you will only be exempt from the federal state taxes. If you're a provider for your own children, you will be exempt from all of the taxes. If you're a provider for your spouse, you will be exempt from all of the taxes as well. So that's basically the basics of the special rule for IHSS providers. So the main rule here is that you are living provider, and in order to at least be exempt from 2 out of the 5 taxes that are available. Now, if you're exempt from federal state taxes and for some reason you see that within your paycheck you're having tax withholdings, uh, you that actual money that is being withheld from you, you can actually get it back. And the only way that you can get it back is by filing a tax return. There's no other method to get that money back. You must file a tax return because IHSS and pretty much any other employer, once they withhold taxes from your paycheck, they automatically send that money to the IRS. So your money, the IHSS, they don't have it. They just the middleman that sends the money to the federal agency. So in order to get them back from them, you need to file a tax return. When it comes to FICA and Medicare, one of the most common questions that I receive from parents who are exempt is like, okay, if I get it, I'm exempt, but is there any way that I can opt in to pay the FICA tax because I want to be able to fund my own retirement benefits? I want to make sure that by the time I reach, I don't know, 67, to have a monthly check for my retirement. Is there something that I can do? Unfortunately, the answer is no. Once you're exempt from the FICA tax, unfortunately, there's nothing that you can do to pay this tax. The only basically the only option that you have is to have a second source of income. Can be any job. You can be self-employed, and through this second source of income, you can start paying your FICA tax to fund your own benefits. But once again, once you're exempt from the FICA tax, at least as an IHSS provider, there's nothing that you can do. You can, even if you want to voluntarily pay it, unfortunately, they will not let you. Updates. This is one of the reasons why my phone has been ringing nonstop for the last week. As I mentioned earlier in the presentation, many of you received this email from the IHSS agency stating that you will start receiving a W-2 form beginning with this tax year. So let's go over the old regulation, the old rules. In the past, with tax year 2023 and prior, IHSS provider who submitted the form, the SOC 2298, and provided the care to their children or spouse, they did not receive a W-2 form to file a tax return. So that was the old rule. basically that was in place for almost 10 years. So many of you have not received a W-2 for that long. I mean, you did had an option of to file a tax return by using your last pay stub that you receive in the calendar year. In many cases, when you file a tax return, sometimes the IRS will accept that tax return without any issues. But in most cases, the IRS will either send you letters um, requesting proof that you were actually that your care recipient was actually enrolled in the IHSS program and that you, as the care provider, resided in the same household as the care recipient. So the IRS was doing a deep investigation to see if you actually meet the tax rules in order to be tax exempt. By doing this process, by utilizing your last pay stub, it was almost the equivalent of you just reporting cash. The IRS, whenever you reported cash or you use your last pay stub, the IRS really doesn't have any way of verifying that income. That's why many times the IRS will put a hold on your tax refund until they did their own investigations to see that you were actually entitled to the refund that you were asking for within your tax return. And if in the past, if you have had any issues with the IRS, you know that the IRS is not known for being very efficient or very fast. If you get in any type of issues with the IRS, it usually is a very, very long process and very mostly frustrating. You can fit in the word there that best suits you, but it was very, very long process. Personally, I still have cases that have been open for the last 2 years, and all of this is because the IRS is very, very, very slow. So that was under the old regulations. New regulations. Beginning with this calendar year, 2024, all service providers will be issued a W-2 form. All of them, no exceptions to the rule. According to these new regulations, I mean, I do expect to see some glitches within this new law. There might be some cases where you don't receive a W-2, but basically, as the way it was written, this new regulation says that pretty much everybody should be issued one. Now, obviously, this triggered a lot of questions, and one of the main questions that I was receiving from you, the IHSS provider, was if I receive a W-2 from now, does that indicate that I'm required to pay taxes? The answer is no. The only thing that changed is the way that the IHSS agency is going to be reporting your wages, and that's via a W-2 form. The tax law that I just explained a few slides ago, that has not changed at all. That it remains exactly the same as it is. Living providers are tax exempt, and and all of those rules that I explained, that still remains the same. The only thing that is changing is that you will receive a W-2, but that W-2 is not ordinary W-2. Within your income will be reported in a special section. I will actually be showing you an image of the W-2 so you can see what to expect. I know probably some of you already received the W-2. I know here at home we have the IHSS service as well. I know my wife already received that form, so I'm pretty sure some of you already received it, but still we're going to be showing you how it should look like. So again, no, receiving the W-2 form does not mean that you're going to be paying taxes. It's, it's just that you're just receiving a W-2 and that's it. What advantages does receiving the W-2 form provide? One of the main benefits is that by having a W-2, you can now verify your income. That was one of the main issues when it comes to the financial planning for IHS provider, that they were having difficulties applying like for personal loans, mortgages, or other government benefits because they didn't have an actual W-2. They did have the pay stubs, but many of these private and government institutions, they want to see the W-2 because for them that's an actual an actual proof that you actually received that income. So in the past, yes, there were ways that you could verify your income, but that involved getting in touch with your county IHSS office. But each county was different. Some of them did had an actual form that you can fill up to request an income verification letter. Others did not. And usually, when you call them up, from experience, I can tell you with LA County, it took us a couple of days to finally get a hold of the person that was in charge. Um, of processing, or the department that was in charge of processing this type of letters. And it took the whole process, it took 1 month to receive the actual letter. In some other cases that I knew about, it took him 3 or 4 months. So all of that will be eliminating just by receiving your W-2. So in my opinion, this is one of the best benefits by these new regulations. That's when it comes that's at the personal level. For IRS purposes, this change will actually make your tax return being processed much faster. The reason is because now, by having a W-2, the IRS will be able to verify your income, and also that you are tax exempt. Like I mentioned, your W-2 will be placed in a special section within the W-2, and it will have right besides it a special code. That code will tell the IRS that you're exempt, basically. And by this method, the IRS will no longer question your tax return. Of course, there's always you can still receive an audit for that, because the IRS, they have an internal lottery. Um, it's not the lottery that you want to win, but this is an internal lottery for audits. So you can always your tax return will always pop up during in that lottery, and you might still receive an audit. But if that's the case, just by having the W-2 will make it easier to even go through that process. Like I mentioned, IRS, it will be easier for them to verify your income and your tax exemptions. It will accelerate the process of your tax return, so it will minimize the wait period to receive your actual refund, and it will cause a decrease in audits. Last year alone, I received over 20 audits for my clients. Luckily, by this time of the year, we have closed most of them, but still, audits are long and painful process. So hopefully, by this new change, those audits will be minimized. Now, am I obligated to take any actions concerning this change? The answer is yes, but only if you have not completed the form SOC 2298 form. I will show you an image of the actual form, but that form is actually the live-in certification form. That's a form that you fill out just to certify that you're a live-in provider. Again, I will show you that image in a second. But if you have already completed that form, you don't need to do anything else. All the new changes that have been implemented will be applied automatically to you. So you don't have to do anything else. If you have not filled out the Form 2298, then, and this is a professional recommendation, is please fill it up as soon as possible. The reason is because by having this form in the system 2298, it will determine how your W-2 is gonna be filled out. Point number two right here. By completing the form 2298, your income will be classified as exempt on your W-2 form. If you do not complete Form 2298, your wages will be reported as regular income in your W-2. It's not the end of the world if that happens to you. That just means that you have to take extra step within the tax return to make your income tax exempt. I mean, it's just a little bit more of work, but you can avoid that extra work by filling out Form 2298. And actually, let me move forward to see. Oh, it's going to be on the next slide. But when you fill out Form 2298, your W-2 your actual wages will be reported on line 12 using the special code. It looks like a number 11, but it's actually two letters. It's capital I. Uh, so this code will be right beside your wages, and that code just basically means that you meet the requirements to be tax exempt. If you do not fill the Form 2298, your income will be reported on line 1. Any income that is reported on line 1 for IRS purposes, it counts as regular income, which means that it could be taxable. So you want to avoid that. Here's the actual form. If you fill out Form 2298, so your W-2 should come to show your wages on this area. Keep in mind that the actual W-2 form, there's different variations to this actual form, but the one that you see in the screen is the one of the most common versions. So you have to look for box 12A. Again, that little code, it looks like a number 11, but it's a double capital I, and your wages right besides it. If your wages are right here in this section, that means that your income is exempt. If your income, on the other hand, is shown on box number 1, that means that for IRS purposes, that your income is classified as regular income, which means that it will be subject to taxes. Again, it's not the end of the world. If your income is shown on box number 1, you just have to take an extra step or tax preparer should take some extra steps, excuse me. But even if you take those extra steps to make your wages non-taxable, that will place you in a position where the IRS might request some evidence that you actually qualify to be tax exempt. So that will cause delays on your tax return. And again, with the IRS, all the processes are very, very long. So you can avoid all of those headaches by just filling out Form 2290. This is the actual Form 2298. It's very simple. Usually you receive this form when you first apply for the IHSS program. And again, it's very, very straightforward, very simple to fill out. You just provide your name, the recipient's name, the case number, your county of residence, your name here again on the bottom. You sign and date, and you actually mail it to the address that is shown right there at the bottom. That's all that you have to do. If you never fill it out, you can just Google it, Google Form SOC 2298, and it will take you directly to the website where you can download it. If you don't have a printer at home, you can go directly to to your local IHSS office, request a copy of it, or in some cases, there might be an electronic version in your electronic portal as an IHSS provider. Now, how do I know if I need to fill it out or not? So if you look at your paycheck, just look under the deduction sections. Look for federal and state deductions. If there's no deductions, that means that this form has already been processed. So you don't need to do anything else. If you see that that you're having deductions under both of these sections, federal and state taxes, that means that you need to submit this form. That's the way that you can figure out if you need to submit it or not. Most of you have already submitted this form. So if that's your case, you don't need to do anything else. This actual Form 2298, when it comes to the three groups of taxes that I showed you previously, it only has a direct impact over the federal and state taxes. Once you fill it out, you will stop having federal and state tax withholdings. So that will stop. Form 2298 does not have any impact on the other two groups of taxes, the FICA and Medicare and the SDI. So, and I mentioned this because a lot of people believe that they've been told that by canceling Form 2298, they might be able to now start paying the FICA tax. But again, Form 2298 does not apply at all for FICA, Medicare, or SDI. It only applies for the federal and state taxes. A little visual summary here of the Form 2298. If you don't complete this form, you will continue to have federal and state withholdings. Your W-2 would indicate standard income or regular income. Your income will be shown on box 1 of the form W-2, and on your tax return, you will need to take additional steps to make your income tax exempt. Also, if your income is reported on box 1 of your form W-2, you must um, file a tax return. That is mandatory because the IRS, whenever you have income in box 1, again for IRS purposes, the actual agency IRS assumes that that's regular income. They have no way of knowing unless you tell them that that income is tax exempt. So because they believe it's regular income, they're expecting from you to file an actual tax return. If your income is reported on box 12, technically, you're not obligated to file a tax return, but it might be on your advantage, especially if you have children under the age of 17. It might be on your advantage to just file a tax return so you could receive some of the credits, which we'll be talking about in a few minutes. So this is the other summary. If you choose to complete this form, there will be no longer tax withholdings for the federal and state. Your W-2 would indicate the exempt income. It will have the special code, and your tax return will be processed much faster than in previous years. Now, usually when you apply for the first time for the IHSS program, along with the Form 2298, they usually also provide you Form W-4. In the past, before this new change, you either had the option to fill out Form 2298 or Form W-4 in order to do the tax exemptions. There were many people in the past who were against submitting Form 2298 for various reasons. So they avoided that form and they just fill out Form W-4 with the special wording here that you see, exempt. This is also a way that you can tell the IHSS agency to stop withholding state and federal taxes. Now, for under these new changes, just if you decide to only submit Form W-4 and not Form 2298, if you do this step right here that you're seeing on screen, that will still cause your total income to be reported on box number 1 in the Form W-2. So if you only submit Form W-4 and you ask them to be tax exempt, this will still not, it will not be enough for the IHSS agency to classify your income as tax exempt. The only way that you can classify as tax exempt is by filling out Form 2298. Now, for this new tax year, actually in the past, beginning with tax year 2022, the IRS added this special line, the one that you see right there in yellow, line 1D. And that special line was for IHSS providers that did not receive a W-2 form. So with tax year 2022 and 2023, you would use this line if you didn't have a W-2. That was the way to go in order for you to file a tax return. Now with this new change that's going to be implemented with this year, all of your income should be reported on line 1. Again, I don't anticipate anyone else to be using line D. Very few exceptions, but the vast majority of you should be using now line 1A, where it shows to record all of your income from the W-2s. But regardless of which, there we go. Regardless of which line you're using, in order to fully exempt your income, your IHSS income from taxes, you need to attach a Schedule 1 to your tax return. In Schedule 1, if you go down to line 8S, you see this special line as well that the IRS placed there back in 2022. It says non-taxable amount. By the way, Medicaid waiver payments, that's the federal term for IHSS. The IRS does not use the term IHSS. If you actually get on the phone with that IRS agent and you tell them my income is from IHSS, they won't know what are you talking about. You need to tell them I have Medicaid waiver payments because that's the federal term. Um, so within this line, in order to be to make your wages tax exempt, right here where you see the parentheses, you need to input your income. It might be shown as a right there as a negative or as a positive number. For IRS purposes here within the forms, whenever you see a parenthesis, that also means negative. So this is one of two ways to exempt your taxes. You either use, I mean, your income from taxes. You either use line 8S or you use line 8Z. If you use this second option, you need to add the special note that says Notice 2014-7, and right beside it, you need to record your income as a negative number. Again, in order for you to be fully considered tax exempt within your tax return, you need to have this form, Schedule 1. If you do not have Schedule 1 and you report your IHSS wages, your wages will be classified as regular income and you will end up paying taxes that you're not supposed to. So please make sure that you have in your tax return Schedule 1 and that you're using either one of those two lines. Let me go back so you can see the other one, either line S or line Z, where you see and apply the notice 2014-7, and your income right beside it as a negative number. Credits. What types of credits can I receive when I claim my dependents? There's various types of credits, but the two most popular ones are the earned income tax credit, and the second one is the child tax credit. The first one, the EITC, for this taxable year 2024, the maximum credit can be up to 7,830. But in order for you to receive this amount, you need to have at least 3 dependents, and your income, if you're head of household, should be anywhere within the range of 17,000 to 23,000. If within that income range and you have at least 3 dependents, you will receive the maximum earned income credit. The actual credit, the way you calculate it, it varies in many factors. One of them is how many dependents are you claiming? Are you single or head of household, or are you married? And what was your actual income? But the maximum credit, like I mentioned, it can be 7,830. Obviously, you can you can receive a reduced amount depending on your circumstances, but that credit is there is one of the it's actually the highest credit that the IRS provides for all taxpayers. And this credit is mainly designed to favor taxpayers who are either low to medium income. The lower your income, the higher the credit. As your income increases, the less and the less you will receive in this credit until if you go above certain threshold, you will no longer qualify for this credit. The child tax credit, it can be as high as $2,000 per dependent under 17 years old. That basically the main requirement, like it says, is your dependent's age. They have to be under 17. For taxable year 2024, they had to be 16 during the calendar year. If they turn 17 during 2024, regardless of the actual date, that particular dependent will no longer qualify for this credit. So they had to be under 17 during the calendar year. Now, dependents with disabilities, there's the belief that once your children reach the age of 18, that they no longer qualify to be your dependent. There's exception to the rules. One of them is if they have a disability. There's other exceptions as well besides disability, but right now we're going to focus on this area. If you have, for IRS purposes, once you claim a dependent who is older than 18, if they have this disability, the IRS the IRS definition of disability is that the person, the dependent, cannot engage in any substantial activities. That basically means that due to their disability, they cannot either obtain a job, keep a job, or earn enough money. So if your dependent, because of its disability, is not capable of doing that, the IRS will classify them as disabled, and the age limit will be eliminated, meaning that virtually you can claim your dependent forever. So you can always claim them. If you are able to claim that particular dependent with disability, that automatically makes you eligible to receive the earned income credit. Of course, you still have to meet other requirements, mainly the income requirement. You need to be under certain threshold, but as long as you keep your income is below that threshold, you can virtually receive the earned income credit forever. I have clients who have been receiving this credit uh, for many, many years, and their dependents already in their 30s, on their 40s, and yeah, they will keep on receiving this credit as long as they claim that particular dependent. And again, this applies for the earning and credit. For the other, sorry, it's a little bit cut off. It should say child tax credit, not a dependent credit. The child tax credit. Um, this unfortunately the main requirement still is the same. In order to qualify for the child tax credit, your dependent needs to be under the age of 17. So they need to be at least 16 in order to qualify. If they're 17 or older, unfortunately, even if they have a disability, they will not qualify for the child tax credit. So main requirement for child tax credit is their age. For earned income credit purposes, if they have a disability, the age limit is eliminated and you can qualify basically for life, forever. Okay, so we were talking about the various types of taxes and what is the and what is the reason behind of us paying that particular tax. For when it comes to the federal and state taxes, I mean that's the tax that everyone pretty much wants to avoid. Even the billionaires of this country, they want to avoid the federal and state taxes. So if you as a living provider, you're already exempt, so fantastic, that's fine that you're not paying it. But unfortunately, if you're the provider for your own children or spouse, that's making you exempt from the FICA tax, which means that you're not contributing towards your Social Security benefits. And that can be a very big disadvantage as you approach the retirement age. The reason is because if you're not paying the FICA tax, that means that either your benefits are going to be very, very low, or in some cases that are like I've seen in the past, there's no benefits at all. So it's very, very important that if you at this moment you're not contributing to to your Social Security benefits, if it's within your possibilities to try to at least somehow through a second source of income to at least attempt to pay some into your fund so that you're able to receive some benefits um, once you reach the your retirement age. Ideally, when you reach that particular age, it can be starting with the age of 62. That's when you can start retirement. Full retirement age is around 67. It's not exactly 67. It varies depending on the age that you were born, but you can start claiming retirement benefits as early as 62. So once you reach that age, ideally you should have a combination of your Social Security benefits plus your personal retirement accounts. If you have both of these, most likely you will be financially well off during those years. The problem here for IHSS providers is that many of them are not will receive very little benefits or no benefits at all. And on top of that, many of you as well, you're not contributing for many reasons to your own personal retirement account. So the future for some of you is not very bright, unfortunately. So you have to start planning now, so you can see what options are you gonna, what are your options right now, so you can receive those benefits later in life. So when it comes to retirement, first of all, let's go over the basics for retirement benefits. Well, besides just paying the actual tax, what is it that you need? What else is needed in order to qualify? First of all, like I said, you need to pay the actual FICA tax. You need to be paying it in order to receive the benefits. And once you're paying the FICA tax, you are able to earn what is called Social Security credits. Credits, you could also call them points, just to not get them confused with IRS credits. But for Social Security benefits, you need to earn 40 credits to be eligible for any of the benefits, which includes the retirement benefits, um, the survivor benefits, the disability benefits, and spouse benefits. Those are the four benefits that are offered by the Social Security Administration. If you want to receive any of those, you need to earn 40 credits throughout your life. The way you earn the credits is as follow. For calendar year 2025, you need to earn at least 1,810 and pay the FICA tax in order to receive one credit. This 1,810, you can either earn it throughout the year, spread out throughout the year, or as a single payment. Doesn't really matter. Once you earn that amount and pay the FICA tax, you will get that one credit. The maximum credit that you can receive per year is up to four. You can receive less than four, but no more than four. In order to receive the four credits, you need to earn at least 7,240. Keep in mind that these amounts they change every single year. They go up every single year. So these are the amounts for 2025. So 7,240 in order to receive the four credits. So assuming that you get the four credits every single year, that's the equivalent of you working 10 years in order to qualify, in order to acquire the 40 credits needed to receive the benefits. If you don't know, if at this point in your life you're not familiar, or you don't know exactly how many credits you have, the fastest way to find out is by logging in to the actual Social Security's website, which is ssa.gov. Once you go into that website, you just go to the section where it says create an account, or log in if you already have one. And once you log in, the very first page that's going to pop up is going to show you exactly how many credits do you have. It's going to show you like a little green bar that it's filling up. And right beside it, it's going to show the actual credits that you have. So that if you do that, that will give you an idea of where you're currently at. Once the system shows that you have 40 credits, right beneath it, it's going to give you an estimate of how much money you can receive once you retire. So again, this is a fantastic page because it can help you plan ahead for the future. So at least this way you will know how much you're going to be receiving monthly from the Social Security Administration. And based on that, you can plan for the other part, which is the retirement. There we go. The personal retirement account or individual retirement account. So what are my options? Okay, so if you already working on your Social Security benefits, now you need to work on the others on the other part of the equation, which is again the personal retirement account. You have various options. Keep in mind that there are many more options, but these four options that I could be showing you right now, excuse me, are pretty much the ones that are within your reach, the easiest to get. One of them is the famous 401k. That's one of the most famous retirement account, but keep in mind that the only way that you can receive a 401k, it's by through your employer. So you need to actually work for a company that offers these types of plan. One of the main highlights of this types of account is that many employer offer what is called the matching program. Matching program just means is that once you apply for this, once you enroll um, with the 401k, it means that for every dollar that you contribute towards your account, your employer may also contribute another dollar. So they will match whatever amount you put in up to a certain limit. So that's basically free money for you for your retirement. And that free money is coming from your employer. So that will help you, your fund to grow at a faster rate. And for 2025, you can contribute up to 22,500. 22,500. That's the maximum they can contribute. Obviously, if you cannot, if you cannot max out this account, contribute as much as you can. But again, the 401k, it's only available through your employer. If you happen to be self-employed, there is a way to get what's called a solo 401k. But in order to reach to be able to get this type of account, you need to have what is called an S corporation. And in order to have an S corporation, pretty much it just means that your business is already uh, generating a fairly good amount of income. I mean, the income doesn't need to be that high in order to have a solo 401k, but I mean, but you must have at least an established business if you're self-employed in order to get the solo 401k. If the 401k is not an option for you, you can go and get one of the IRA accounts. There's two types. An IRA account, first of all, it stands for individual retirement account. You have either the traditional or the Roth IRA account. The difference between the two is the following. If you have a traditional 401k, that means that the contributions that you make into that account are tax deductible, and the earnings you only pay taxes on the earnings once you start pulling out the money from the account, usually by the time you reach retirement. So you do pay taxes on the earnings, and but you only pay taxes once again once you pull the money out. As long as the money is inside the account, the taxes are deferred until you actually do the withdrawals. The Roth IRA is the complete opposite. So the contributions are not tax deductible, but the earnings they grow tax free. You will never pay taxes on your earnings from a Roth IRA. Now, which one benefits you the most? It depends. In my opinion, if your only source of income it's from IHSS, if that's the only income in your household, probably will be more beneficial to have the Roth IRA. Why? Because the traditional IRA, the contributions are tax deferred. If by default you're already tax exempt, you do not need any additional deductions. So the best route for you will be to go with the Roth IRA. Um, on the opposite side, if you do have a second source of income, whether it's you having a another job or your spouse has a job, probably the best option will be a traditional IRA. So it depends on your household financial situation. So that's the second option, and you can contribute up to 7,000 per year. If you're under 50 years old, if you're over 50, you can contribute up to 8,000 per year. Those are the maximum contributions. There are no minimum contributions. There are options that you can do, and these options right here is mainly for short-term goals, but it's a really good option. Is the high yield savings accounts. These types of accounts have become more and more popular, and it's because they do provide a very decent rate of return. Usually, the average right now that the various banks are advertising is about 4% interest. So you will earn 4% just by having your money sitting on that account. you don't need to do anything else. With the 401k or IRA account, you do need to pick the type of investment that you want you to place your money in. With the high yield savings account, you don't. All you need to do is put your money there, and that's it. You will receive the 4%. But the only thing to keep in mind with the high yield savings account is that the 4%, it can always change. It's not a guarantee. The bank can at any time decide to go from a 4% down all the way to 1%. It's up to them. It's mainly based on the state of the economy, but right now it's still, for the last few years, they've been at a constant 4%, sometimes higher, at up to 5%. But it's a good option for you to start earning some money, um, for either retirement or for some short-term goals. The last one is the federal government bonds, most specifically what is called the I bonds. This type of investment is pretty much, the way it works is that you're providing a loan to the federal government, and in exchange, the federal government is, first of all, they're guaranteeing your investments. That means that your investment is really close to 100% secure. None of the investment are 100% secure, but this is the closest or the most secure type of investment. The reason is because I bonds are backed by the federal government. So if the government, the only way you will lose your money is if the government goes bankrupt. Additionally, the government also gives you the promise that if you hold on to these bonds for at least 20 years, minimum, your initial investment will be double as a guarantee. So that's the guarantee. The statistic shows that they usually grow, they actually triple instead of doubling, but at least the federal government gives you that guarantee. The way that you can buy the I bonds, there's actually two ways that you can buy them. You can buy them online on the Treasury Department of the Treasury's website, or you can buy them through your tax return. If you happen to have a refund, there's a special form that you can fill out to use part of your refunds to buy the I bonds. If you decide to buy the I bonds through your tax return, the IRS will actually mail you the paper bonds. It will, with the actual amount that you bought. If you buy them online, you will not receive the paper bond. Your bonds will be electronic. It will be accessible at any time during the website, but that's the main difference. If you want the actual physical, it's like an actual check. If you want the physical bond, you will need to buy them through your with your tax return. Cal Savers, this is actually most of you receive an email from the IHSS agency. If I'm not mistaken, it was about a year or maybe 2 years ago, where they were promoting this type of retirement account. Many living providers believe that this was a special type of account, retirement account for IHSS provider. But no, in reality, Cal Savers has been around since 2019, and it's available for pretty much any people within California. So Cal Savers is basically a Roth IRA type of retirement account. The difference is that it's managed by the state of California. The purpose of the Cal Savers is that the government is promoting um, promoting savings for retirement. There is actually a huge problem right now because not many people are saving up for retirement. So this is an effort for the government, um, it's an effort for them to try to incentivize Californians to save up. So again, Cal Savers is a voluntary program. If you want to enroll, uh, you if you once you enroll, you can have direct deductions directly from your paycheck. So call savers can pull the money that you tell them directly from your paycheck, and it will get automatically transferred to your account and invested in whatever option that you pick. Mm. So, like I mentioned previously, with Call Savers, it has exactly the same details as any regular Roth IRA. The maximum contribution is 7,000 per year if you're under 50, or 8,000 if you're over 50 years old. This is a good option. I mean, there are better options for IRAs. Those better options, you will find them like in banks like Charles Schwab's, TD Ameritrade. The reason I say these two that I mentioned are better than Cal Savers is because, like Charles Schwab's, for example, they have a greater variety of investment options in comparison to Cal Savers. Cal Savers, they do have very limited amount of investment options, but in my opinion, if you're not very familiar with investments when it comes to retirement accounts, Cal Savers is a good start for you. I mean, at least with CalSaver, you will not be overwhelmed by the amount of options that you have in comparison with the other banks like Charles Schwab's or TD Ameritrade. So it's a good option to get started. If you get started with CalSavers, you can always in the future, once you get yourself comfortable, a little bit more knowledgeable about the financial implications of these types of account, you can always do a rollover to another account. So it is a good option to at least get started. Just a little warning, any if you have dependents, minor dependents younger than 18 who receive SSI, you gotta be careful whenever if you're planning to open a retirement account. Your retirement account do count as assets for SSI purposes. As you if your son is receiving SSI benefits, you're pretty aware that those benefits are based on the parents' um, resources, on your income. So, as you probably also know, you cannot have over $2,000 in any type of account, because otherwise, if you go over the $2,000, your benefits will be reduced. SSI benefits will be reduced or eliminated. So just keep that in mind if you have dependents, minors with SSI. If you open any of the previous retirement accounts, they might impact your child's SSI benefits. Just bear that in mind. And once they're over 18, that's fine. You can open any type of retirement account. Life insurance. I'm going to be talking very shortly about life insurance, and going to focus a little bit of the types of insurance that are available and the tax implications. So first of all, why do you need, as an IHSS provider, why do you need life insurance? First of all, the purpose of a life insurance is the income replacement in the event of the loss of the primary breadwinner. Like I said, sadly, last year I did um, known several people that unfortunately passed away. They were mainly single moms with two or more children, one of them at least one of them with disabilities. And unfortunately, they were the head of the household. They didn't really had any support from any other family members. That tragic hit these homes. The the head of household and ended up passing away. So now their children are in a financial limbo because not only is their mom no longer with them, but also there's no money available to support them. So in order to at least alleviate this strategy, at least to have some financial security, if the head of household happens to pass away. That's one of the main reasons why you need life insurance, is to protect your descendants, at least financially. So at least they can have some money available for them. Um, to at least until it's decided, or until they reach an age where they can decide what the next steps is going to be. So, and also within life insurance, some of the things that you can do is also that you can protect your minor children, especially those who have a disability. Once again, unfortunately, some of the tragedies that I got to see last year, I saw a couple where the children with disability passed away. And in those two cases, Um, Again, the very similar scenarios. It was a single mom, and because the children with disabilities, the one that passed away, also along with him, the IHSS income is gone as well. So in those two cases, that was the primary source of income of that household. So once the child is no longer with them, it's also the IHSS income is also gone as well. So you gotta prepare. I know these are difficult conversations to have with your families, but it's, in my opinion, is a necessity to at least be protected financially in case either the head of household or one of the childs happen to pass away. Um, you gotta look into those areas. Okay, so insurance. There's two types of insurance that you can that are available. The one of the most common ones is called the term life insurance, and as the name implies, is temporarily. Term means temporarily, and usually most insurance do term insurance, life insurance do not go over 30 years. They're either for a period of 30 years or less. Um, but that's one of the most common life insurance, and they're typically one of the cheapest ones to get. So that's one of your options. The second one is the whole life insurance.
It seems that Eduardo froze, so we're just going to give him a minute to come back. Thank you for your patience. And Eduardo, can you hear us? There you are.
You can hear me now?
Yes, yeah, you froze for a second.
Ah, okay.
Okay.
Okay. So I'm back now. Okay, so let me repeat what I was saying. There's two types of life insurance. You have term life insurance, which is temporarily life insurance. Um, it can be for up to 30 years, or it can be less. And the other type of insurance is whole life insurance, also known as universal or permanent life insurance. And it's pretty much for you can have that insurance forever as long as you keep making the monthly payments. The Go over here. Some of the benefits within these two types of life insurance, with term life insurance, is that it is tax exempt for the beneficiaries. So if you are the policy owner, once you pass away, your beneficiaries will receive one lump sum. Well, you do have options, but if they receive a lump sum of the proceeds, they will all be tax exempt, and the actual amount of the policy, well, you determine how much you want the policy to be. The actual amount, it can be as low as 50,000, it can be in the millions. So whatever amount you pick, it doesn't matter what the amount is, it will be tax free for your beneficiaries. So that's one of the greatest advantage of having this type of insurance. Not only it will provide a financial blanket for your beneficiaries, they also don't won't have the necessity to worry about Uncle Sam. So they won't have to worry about taxes because once again, it will be 100% tax free. With term insurance also, it's reduced monthly payments. They are typically cheaper. They can be as low as $20, $30 a month. The higher the policy amount, obviously, the greater the monthly payment is going to be. But again, you get to pick how much you want your policy to be, but they're relatively cheap insurance that you can get. With permanent or universal life insurance, that's a type of insurance that also enables you to do some types of investments within the actual policy. There's many types of investments. I mean, we can go forever here, and if we dive in deeply into this type of insurance. But what I just want you to keep in mind about the permanent life insurance is that it has an investment component within it that can generate additional income. Permanent life insurance can also be used as a way to save up for retirement. It might not be the best options, but if you combine it with other like IRA account, 401k, then it could be beneficial to use permanent life insurance also as a way to save up for retirement. So you receive two types of benefits. Not only your beneficiaries will be covered in case you pass away, but also it's generating additional income. And the only thing to keep in mind with permanent insurance is that it has higher monthly premiums in comparison to the term life insurance. It's more expensive, and you do pay taxes on the profits. And again, the taxes they will only be paid once you pull out the money from the account. So those are the two types of life insurance that are available. And going back to the warning that I gave you like 2 or 3 slides ago about the minors with SSI, if you have a minor with SSI benefits, having a permanent life insurance or whole life insurance can affect their benefits, their SSI benefits. Just keep that in mind. The reason is because whole life insurance is generating income. If the income is high enough, over $2,000, it will kick him out of the system. Term life insurance, it it will not have an impact over your SSI benefits. So if you're considering on buying life insurance, the well, again, it's not a one size fits all, but if SSI for your minor children is a main concern for you at the moment, I'll opt in for getting the term life insurance. And as they get older, probably you can consider having the permanent life insurance. If you don't have SSI benefits at home, explore both options to see which one fits you the best. Now, what should be the appropriate amount of my policy? The standard guide for at least for term insurance is that you should get at least again, this is the what most experts recommend, that you get at least 9 to 10 times the annual income of the primary breadwinner. And this example, if you make 50,000 annually, your policy should be anywhere between 450,000 to half a million. That's just to give you an example. The reason they recommend this 9 to 10 times the annual income of the primary breadwinner is to give enough time to your descendants, your beneficiaries, um, to prepare for the future. At least this way they will have enough money to cover their expenses for various years, for many years, until they reach an age where they can be more independent. So again, this is just an example that you can consider. But the actual amount of the appropriate amount of your policy is actually should be tailored to fit to your financial plan to fully realize its potential. Again, there's no one size fits all type of life insurance. You should consider all um, all of your financial details within your household. Also, just a little tips when it comes to life insurance. If you are considering getting life insurance, or if you already have life insurance, refrain from designating your disabled dependents as beneficiaries in your life policy. Don't name them directly as a beneficiary within your policy, because the reason is because if you pass away, they will receive this lump sum of money, and now they're not going to be able to qualify for most, if not all, of the government benefits. So you might think that you're provided a benefit to them by naming them in your policy, but in reality, yes, they will have the actual amount on their hands, but unfortunately, they will no longer qualify for their government benefits like SSI, just to give you an idea, maybe also for Medi-Cal if they receive that large amount of money at once. So that's something to consider. Not name the not to not name your disabled dependent directly on the policy. Instead of doing that, consider designating a living trust as your beneficiary. Again, this is all part of a financial plan, but this is a really highly suggestion option given by many financial experts. You should create at one point a living trust, and all of your assets should name that living trust as the direct beneficiary. Within the living trust, you can write instructions as how your assets should be distributed to your descendants, so to your children. So again, living trust itself is an entire presentation on its own. So, but just keep in mind, just a little tip here for you. All of your assets, try to put them under a living trust, including life insurance. Okay, we reached the end of the presentation. There's my contact information if you have any questions about the topics that we have covered during this presentations. And so I'm gonna stop the actual presentation here so we can take some questions from you.
Okay, first let me stop the recording. Thank you so much, Eduardo. Let me stop.
Sure.